We've helped thousands of people retire over the last 30 years, and in that time I've learned nearly everything about when you should retire and how to retire, but also what to avoid like the plague when retiring. Because you might be shocked to know that retirees in the UK are overpaying in taxes, missing out on key investment opportunities, and most concerning of all, running out of money far sooner than they expected to. So in this video we're going to dive into the key lessons and strategies that most people miss and cover pensions, investments, tax planning, and clear up all of those retirement myths. Let's start with a simple but important question. How much do you think you'll need for a comfortable retirement? The reality for many is that they severely underestimate the amount they'll need. The average UK pension pot is around £107,000. However, most people will need between £500,000 and £700,000 to retire comfortably. That's across all assets. Why such a big gap? Well, it's because most people don't factor in how long they'll live and how inflation can erode the value of their savings over time. So consider this. If you retire at 65, you might live for another 25 to 30 years. Could your savings last that long? And what about rising healthcare costs or your plans to travel and enjoy your retirement? So we're going to explore how to plan properly throughout this video, but as a quick piece of advice, never underestimate how much you need and take your saving and investing very seriously. Planning for retirement is not something to just put off until later. It's something you need to be actively thinking about and working towards all of the time. If you need help with it, well, that's nothing to be ashamed of, because it's much smarter to ask for help and set yourself up for success instead of staying in the dark and trying to wing it. Which leads me to my second point. It's a simple fact. Time is your best friend when it comes to saving. If you save just £100 a month from the age of 25, let's say with a 5% return, which is very conservative over the longer term, you'll have over £160,000 by the time you're 65. But if you wait until 35 to start saving £200 a month, that's a massive difference when you consider that you only invest £48,000 in scenario 1 and £72,000 in scenario 2, but you end up with roughly the same amount of savings by simply starting 10 years earlier. The key here is that with compound returns, those small sacrifices that you make early can grow into substantial savings later on. So start early, even if it's small. So now let's talk about something that, whilst it guarantees you some income and gives you a little bit of assistance in staying afloat into your retirement, it really shouldn't be the only thing you rely on when you get to retirement, and that is your state pension. So the current state pension is £221.20 a week, which amounts to just £11,500 a year. Now, for many, this is far from enough to cover your essential expenses and any kind of reasonable lifestyle, let alone maintain the lifestyle you're accustomed to or might really want to enjoy in retirement. So consider your own living costs. You've got housing, you've got bills, groceries, healthcare, and of course leisure. Could £11,500 a year truly give you the retirement that you want? On top of all of that, the eligibility age for state pension is currently 66, but it is set to rise to 67 between 2026 and 2028, and with further increases likely to come in the future as life expectancy continues to grow. This means many of us will have to wait a lot longer to receive even that modest amount. So as a result, it's becoming increasingly clear that relying solely on the state pension is absolutely not a viable option for most people. To enjoy a secure and comfortable retirement, personal savings, investments, and pension contributions, as well as perhaps your residential property and downsizing, will absolutely play a critical role in bridging the gap and ensuring financial stability in later life. Now, before we dive into strategies, let's talk about the 4 biggest mistakes people make when planning for retirement. The first, not having a clear idea of how much you'll actually need. Too many people underestimate how inflation, healthcare costs, and emergencies can eat away at their savings. So ask yourself, have you calculated what it'll take to maintain your lifestyle? Have you factored in rising costs? Because a £30,000 a year budget today could look very different in 20 years' time. One of the biggest overlooked expenses is healthcare. Long-term care in the UK can cost over £50,000 a year. And without a plan, it can drain your savings fast. The key is to prepare, whether that's through long-term care insurance, budgeting for medical costs, or setting aside a dedicated fund. By planning ahead, you protect yourself from unexpected expenses and you keep your retirement on track. Now, the second mistake that I see just about everybody make has to do with tax-free cash that you're allotted in your pension. It's very tempting to take the 25% tax-free lump sum from your pension as soon as you're eligible. However, if you don't need the cash immediately, leaving it invested is generally a much smarter move. This allows your pension to continue to grow, which benefits from compound returns and market gains, which could provide a larger cushion for the future and a larger 25% tax-free cash. Withdrawing early reduces growth potential, and it may also limit your tax efficiency because any future earnings on the withdrawn funds won't have the same tax advantages. So a word to the wise, really consider delaying your withdrawal of your 25% tax-free cash to maximize your pension's long-term value. And ask yourself this simple question: do you really need that cash now, or would leaving it invested be much smarter for your long-term financial health? Because generally it will be. Now, mistake number 3. The fact is that many people sign up for their pension and then never look at it again. It's extremely important to regularly review where your pension is invested and whether it still aligns with your risk tolerance and, more importantly perhaps, your retirement goals. If you haven't checked how your pension is performing in a while, it could in fact be underperforming significantly. And if you haven't reviewed your pension or your retirement savings for some time, that's completely normal. Lots of people don't know where to start, what they should be looking for when they review their pension or savings generally, or their retirement plan, and ultimately what they need to do is set themselves up properly for retirement and have a great plan, which is why I'm offering you a free in-depth pensions and retirement planning review, which is something that people usually charge over £800 for, with no strings attached in our case. It's a great opportunity to sit down with a retirement expert one-on-one, review your financial situation, set some clear defined goals, and create a customized plan for a stress-free retirement specific to your own situation. So don't leave your future up to chance. Take your retirement seriously and go ahead and click the first link in the description below to book your free review today. On to mistake number 4, and this is something that many people overlook routinely, even though they're automatically enrolled in a pension and receiving tax relief. It's very important to ensure you're maximizing the relief available to you. The reality is that pension contributions are a really powerful way to save for retirement. That's a fact, thanks to the valuable tax relief provided by HMRC, and we don't get a lot back from them. So essentially, when you contribute to a pension, the government effectively tops up your pension based on the income tax rate you pay. Here's how it works in a bit more depth. Well, basic rate taxpayers, which would be 20% in today's world, for every £80 you contribute to your pension, the government adds an extra £20, making your total contribution £100. This means you only pay 80% of the cost to achieve a full £100 contribution. Put another way, that's a 25% gain for no risk. Now, higher rate taxpayers, which would be 40% in today's world, well, higher earners can claim additional relief through their self-assessment tax return. So for every £100 you contribute to your pension, you only really need to contribute £60 out of your own pocket, as you can claim back the other £40 through tax relief. Additional rate taxpayers, 45% in today's world, those in the top tax bracket benefit the most. For every £100 you contribute to your pension, you effectively only pay £55 out of your own pocket, thanks to the combined tax relief added directly to your pension and claimed usually through your tax return. So you need to ask yourself, are you taking full advantage of this? If you aren't using salary sacrifice or claiming extra relief via self-assessment, you could be leaving thousands of pounds on the table and be making a huge mistake, which we don't want you to make. Let's shift gears for a minute and talk about how you can invest properly to prepare and have enough funds for retirement, because here's a tough reality. Cash savings won't keep up with inflation. If you leave £10,000 in a savings account, it could be worth just £7,500 in 10 years. One way to help your savings grow faster than inflation is by investing in assets like stocks and shares or index-related funds, or generally just great investment funds, which of course we could pick for you. Another option is fixed interest investments such as term deposits. These offer stable returns over time. The key is to choose an approach that aligns with your financial goals and your risk tolerance. And also, you must understand what risk really means when we talk about long-term investment. The key to doing that is through diversification. Diversification is a simple but effective way to reduce risk, and by spreading your investments across different sectors, regions, and asset classes, you reduce the likelihood that any one market downturn will severely impact your portfolio. Now, on the flip side, if all your eggs are in one basket, you're taking a big risk, but there are ways to solve that problem, which we'll talk to you about if you do a one-to-one with us. Now, let's talk about how to get the most out of your retirement funds. In the 2024-2025 tax year, the first £12,570 of your income is tax free. If you can, it's smart to structure your pension and ISA withdrawals to stay within that limit, keeping more of your money tax-free. But there's something else that can take a big bite out of your savings, and it's called capital gains tax, often referred to as CGT. This applies when you make a profit from selling certain assets, and it can seriously impact how much you actually keep. So who does this affect? Well, investors who sell shares or bonds outside of the tax-free wrappers like ISAs could owe CGT if their gains exceed £3,000. That's in this tax year. Now, property owners who sell second homes or rental properties might also face CGT if their profits go over that same allowance, and with property that's actually quite easy to do. But your main home is almost always exempt. Art and collectibles worth over £6,000 like antiques or jewellery can also trigger CGT. And finally, trustees may need to pay CGT when selling assets like property, businesses or stocks, though their allowances are usually lower than for individuals. So understanding these rules can help you plan smarter and keep more of your money where it belongs, in your bank account. Now, mitigating capital gains tax comes down to smart planning. One effective strategy is spousal transfers. By transferring assets to a spouse or civil partner before selling, well, both individuals can use their CGT allowance, which doubles it in effect. Another option is investing through ISAs. Any gains made within an ISA are completely tax-free, meaning there's no CGT to worry about at all. Then there's tax planning. Well, timing the sale of assets across different tax years allows you to take advantage of multiple annual allowances. Offsetting gains from other investments can also help reduce the overall tax burden. That being said, not all gains are taxable in the first place. If you're selling your main home, for example, you typically won't pay any CGT, provided you meet the private residence relief conditions. Assets held within an ISA or a pension are fully exempt from CGT, so any gains made inside those particular wrappers won't be taxed. One of the reasons why pensions and ISAs are so attractive for good tax planning. Now, additionally, UK government gilts and premium bonds are also exempt from CGT altogether. So with the right approach, it is possible to minimise or even eliminate altogether any CGT liability. Now, if you're unsure about anything we've covered or just want more info, don't forget you can book a free one-on-one meeting with an expert advisor. Just click the link in the description and get your retirement planning sorted. Now, like we mentioned earlier, you can usually take 25% of your pension pot tax-free. The rest, well, that gets taxed as income. If you take big withdrawals, you might even end up in a higher tax bracket. A smarter move is to take smaller, tax-efficient withdrawals over a period of time. Or if you don't need the money yet, just leave it in your pension and let it grow. When it comes to making the most of your retirement income, tax efficiency is absolutely key. ISAs and SIPs are two of the best tools for that particular job. With an ISA, your investments grow tax-free and you can withdraw money whenever you like tax-free. You can put in it up to £20,000 per year. SIPs, on the other hand, come with tax relief on contributions, as I said earlier, up to 45% if you're an additional rate taxpayer. They also grow tax-free, and you can usually take 25% lump sum tax-free when you retire. So using both of those vehicles can give you a great balance of tax benefits now and flexibility in the future. Now, another thing to think about is inheritance tax, commonly referred to as IHT. Now, nobody likes to talk about it, we get that, but it is very important. Gifting money using trusts or keeping funds in your pension at the moment can all help reduce how much of your wealth gets taxed when you eventually pass it on. Now, right now, pensions are generally IHT free, but that could change with Labour's autumn budget, so it's worth keeping a very close eye on and planning for it accordingly. At the end of the day, smart planning with ISAs, personal pensions and estate management can help you keep more of your money and pass on more to your loved ones when the time is right. Now, something I'd kick myself if I didn't include here are some common thoughts and misconceptions that retirees come to me with when it comes to planning for their retirement. Now, many people have certain assumptions about what their lifestyle and finances will look like, but these assumptions often don't align with reality, and it's really important to address them to avoid potential surprises down the road. So let's go ahead and explore 3 of the most common thoughts that people have when planning for retirement and why they definitely need a closer look. Number 1 is, I'll spend less in retirement. Well, that's a really common misconception, folks, that we'll spend less in retirement, because in fact many people spend more in the earlier years as they travel or take up new hobbies, or they tick lots of things off their bucket list, which is often very long after years at work. Have you considered that your retirement might come with a spending surge in the first 5, 10 or even 15 years? Well, this is something that you absolutely need to factor in and plan for it. Next, we have, I can rely on the state pension. The state pension in the UK is £11,500 a year, which is far less than most people need to live any kind of decent lifestyle, let's be honest. Can you really rely on it on its own? I doubt it. And if not, you'll need to supplement your income with personal savings or investments. And third, we've got, I'll downsize my home, it'll be fine. Whilst downsizing might sound like an easy solution, and it is in a lot of people's heads to do that, it does come with hidden costs. You've got stamp duty, you've got moving fees and potentially high property prices in the new market. So it goes without saying, but really make sure that you fully understand the costs before you make any decisions about your home. I might also add that lots of people love their homes and they want to stay in their homes for as long as possible. So at what point will downsizing become a reality? You do need to think about that really carefully, folks. And that's all the advice and wisdom I have to offer after 28 years of helping people retire. That being said, if you're looking to retire, you might be a lot closer than you think, because there are just 5 questions that if you can answer yes to, you might be able to retire way sooner than you think. So click here to check out the next video where I'll show you what those 5 questions are and what they mean for your retirement. And by the end of that one, you might have the answer that you're looking for and be ready to retire. And I'll see you over there.